There's opportunity there.
The boosters on the heart to get everything pumping again. The hot air balloon gets so high in the atmosphere that it naturally bursts.
Being proactive and learning from the past.
If the RSI is over 70, what that normally tells you is that particular stock or sector has been overbought. Never ever think you've won.
Hello and welcome to EXANTE's Surfing the Curves channel. Today I'm lucky to be speaking to a new expert, Jason Keogh. He's head of EXANTE's UK operations and has more than 28 years experience in bond and equity markets, working in Geneva, New York and London. I'm going to be speaking to Jason about current equity valuations, which are at an all-time high. What does that mean for investors and how can they protect their portfolios? Let's speak to Jason and find out more.
Good morning, Jason. It's lovely to have you with me this morning. Thank you so much for joining us. Jason is head of UK sales for EXANTE, based in London. And you've been with the company for what, about 6 months now?
8 months actually.
Oh, 8 months. Wow. And you're building. Excellent. And you're building our UK headquarters, aren't you?
Yes, absolutely. Yeah, we've got 10 people in London now in the sales department. And obviously working from home due to COVID, but hopefully we'll be back to the office pretty soon.
Fingers crossed. It'll be nice to actually see some people again, not just virtually.
Exactly. I know. Forgot what a human looks like.
Exactly. I know it's all kind of 2D. It's getting a bit difficult for just the brain processing. Yeah. But Jason, today we're going to be talking about the state of the markets. Obviously, COVID-19, the situation is changing daily. We've had some, we've had the Prime Minister announcing what's going to happen in the UK in terms of lockdown restrictions. But nobody really knows what's going on because unless you've got a crystal ball, we don't know whether there's going to be a third wave, whether there's going to be further lockdowns. Hopefully not. But you and I are going to talk about the current state of the market because, as you know, the market is at an all-time high, valuations at an all-time high. And that can be quite concerning for some investors. Obviously, there's opportunity there, but also, everyone's kind of wondering when it could all go wrong. But can you give me a bit of an idea, first of all, about, why how you think we got here and why you think the market is currently like this?
Yeah, so I mean, the first thing to say is there's never a right or wrong answer with this. It's normally people's opinions, and everyone has different opinions. My opinion is, if you go back to 2008 when we had the financial crisis, and the world and the financial markets were in absolute meltdown, there needed to be something done that was of a proportion that's never been seen in history before. And the central banks of the world and the governments came together and put in a humongous amount of quantitative easing and stimulus. What that did was, if you look at, sadly, as someone who's had a heart attack as an example, a heart attack victim, someone's come along and given the boosters on the heart to get everything pumping again and bring them back to life. And that's what happened with the financial markets. Now, unfortunately, from 2008 onwards, there's been other situations and crises that have happened, whether it be Brexit or different things. And the market's obviously fallen hard. And what tends to happen, or what's happened, contrary to history prior to 2008, is central banks and governments keep coming along and keep doing more QE and more stimulus. And what that's effectively generated is this huge boost and created this push of all asset classes up. So if you look, for example, at the equity markets, you've seen a massive move higher over the last 10 or 15 years. Even after big dips, generally what's happened is buyers have come in and loaded up again because they know that the central bank's going to come along and do more QE. Now, even in times of crisis like COVID and Brexit, if you look back, actually the markets have gone higher during COVID, which when you think about it is quite crazy because everyone's stuck at home, no one's spending. Unless you go to Amazon, most people aren't going to cinemas or to gyms. So companies are losing money all over the place, but the markets have continued to rise. And that's because governments, the Chancellor in the UK has put in hundreds of millions of pounds to to support the UK. That's happened all around the world, like the US. So then again, you get this more momentum and upswing, and it just pushes markets higher. If you look at Bitcoin, which is going crazy at the moment, every time I look, it looks like it's gone up another 1,000. I mean, yesterday it was around about 52,000. That's continually pushing higher as well. So every asset class is moving higher. Now that's great if, a month ago, 6 months ago, 4 years ago, you bought them, you're doing very well. But there comes a point where what goes up must come down.
I was just about to say that. That was my thinking as well.
And nothing stays up forever. So if you think of it as a hot air balloon, if the hot air balloon is constantly pushed higher with hot air, it will get to a point where some things happen. One, the hot air runs out. Two, the hot air balloon gets so high in the atmosphere that it will naturally burst. Or three, a bird will come along and pop the hot air balloon. And all in those situations, what will generally happen is the hot air balloon will collapse and fall down to market, depending on what happens at different speeds. Some slow, some crashes. And what everyone is fearing is now we've got to market highs and daily highs, weekly highs, constant highs. What's going to happen next? Do those highs continue, or do we get a crash? And that's the bit no one can agree on, because with Biden coming along, who's more to the left socialist, his plan is to put in billions and trillions of more money. So you've constantly got governments, because of COVID, adding more money. So the hot air balloon's going up, but there will become a point where that hot air balloon will fall. I can't give you the reason why. If I knew the reason why, I'd be a multi-millionaire. But it could be anything from the US central bank saying that they're slowing down on QE. It could be sadly, a lockdown. It could be COVID takes a different level. It could be a war. There's lots of things going on with China and Taiwan at the moment. So there could be a multitude of reasons that create a crash. And then there could be just something that no one has thought of, that just comes out of the blue.
Yeah, I mean, and the thing is as well, it's how long can you keep printing money? I mean, and where does all this printed money go? I mean, how do we, I guess, reclaim that? Because people have been talking about inflation, or taxes being increased, because actually the money has to come back somewhere.
Yeah, well, it's definitely inflationary, and inflation's going up. Taxes will definitely go up, just for the simple reason of paying for COVID. If you look at the UK, the numbers that have been borrowed to do that are phenomenal. And sadly, the likes of you and myself and our viewers will end up having to pay more tax to compensate for that. Can you keep printing money? Well, you can't, because there'll become a point where money will become, or the printing of the money will actually become ineffective.
Yeah,
and that's a real danger. And I don't know if you remember Monopoly. I mean, playing Monopoly, I would always try and sit near the banker to try and get the money when my mum or dad wasn't looking, because ultimately you want more money. The more money you have, you can buy the houses and the train stations, but that Monopoly money wasn't real. So you could have as much as you want, but at the end of the day, it didn't mean anything. And we're getting to that point now where how effective is stimulus and QE? At the beginning in 2008, it was absolutely essential. Now it's becoming less, it doesn't work as much. And if you think of it as medicine, when you're ill, you take medicine. If you take too much medicine, it becomes it doesn't work as much. It's why everyone's trying to stop penicillin at the moment, because it's overused. So it's the same as QE. It's been overused, and I sadly think we'll get to the point where the next crash we have, when governments step in to do more QE and stimulus, the market won't accept it, and that's why I think you'll see a much more severe crash. And because I think we're in a bubble. The biggest discussion in the world right now is, are we in a bubble? How much of a bubble are we in?
Yeah.
I think we're in a humongous bubble that's across all asset classes. And if that bubble bursts, then we're in big trouble.
Yeah.
But
it's a shame.
There's ways you can look at that and look forward, and hopefully not put your portfolio or investments at risk.
Yeah, well, I guess it's about learning. It's about being proactive and learning from the past, because it looks like that's what we haven't done in terms of, we like you said, we're kind of trying to do the same thing as we did in 2007, 2008, which will only have a short-term, it'll be a short-term solution, and we're going to be back here maybe in another 10 years, another 12 years, 13 years, whatever it is. But you say that actually there is stuff that we can do to protect our portfolios, especially, using the EXANTE platform. There are things we can do. Can you explain a bit more?
Yeah, so listen, I don't pretend to be the guru of investing, and no one can protect themselves 100%. But if you take the EXANTE platform as a multi-asset platform as it is, that in itself is one clue. So you have to have a diversified portfolio. The worst thing you can do is have all your eggs in one basket. So, for example, if you're only long US stocks, your risk is much higher, because if the US stock market collapses, there's nothing else around it that can support or offset that. So you need to have a diversified portfolio, and on the EXANTE platform, we offer equities, bonds, futures options, metals, crypto, a big variety of asset classes. So spread out your risk. The other thing you can do is, everyone in the investment community thinks that you can only be long, but you can actually be short as well. So you can have short positions. So you could be, for example, 70% long and 30% short. If the market comes off, your shorts will benefit and stop some of the pain of the 70% of the longs. You have to have alerts in place, and you have to be alert yourself. Now, no one can predict when something bad happens, but what you can have is the platform tell you when something starts to look like it's going bad. So you can set alerts. So the main indexes, whether it be the S&P or the FTSE, currency markets, the big pairs like cable, etc. You can set alerts, and all of a sudden, if you see percentage moves to the downside, that will obviously alert you to have a look and see what's going on. If it's just one asset class, normally it's specific to the asset class. All of a sudden, you've got multiple alerts that are coming down. Then obviously you need to prepare yourself and look to see what's happening.
Yeah. And is there any particular asset class that you think could be in danger? I mean, obviously, with the lockdown restrictions being eased gradually over the next few months, people are already planning parties for June the 21st, where they all weddings are going to be back on, and we're going to be able to have, these massive gatherings, which is, in my opinion, a bit unrealistic, because at the end of the day, that is the goal. However, that goalpost can change based on what's going to happen over the next few months, and nobody knows. Is there any kind of asset class that you think could suffer more, or we should be looking at?
Yeah. I mean, listen, I'm an equity man. I've been in the equity markets for 28 years. Equities concern me because, if you think about what is an equity, so let's take a well-known brand like Marks and Spencer's in the UK. What's happened to Marks and Spencer's over the last year? Well, less people have gone to Marks and Spencer's because they can't because of COVID. And the same for cinema brands, and the same for a multitude of different companies. Just in the UK, picking the UK for 1 second. And this is what worries me, is equity markets continuously going higher. And a strong equity market is normally because the companies within that index are doing well. But we know they're not doing well. There's very few companies in the world that are doing well. If you take out someone like Amazon or companies like that, your general company in the UK is not doing well, and that's because everyone's sat at home and can't spend. So for me, the big concern is the markets have gone higher in very bad times. Why have they gone higher? Well, they've gone higher because of all the artificial money that's been thrown into the marketplace. And when that stops, yes, we'll be able to go out and go back to the Marks and Spencers and the cinemas of the world. But who is going to go out and start spending a lot of money, big money, very quickly? Not many people, because a lot of people have been very badly financially hurt over the last year, lost their jobs, been sick, been made redundant. So I think actually the most dangerous period is coming up now, because everyone is presuming on June the 21st, the floodgates are going to open and everyone's going to go out and party like it's the beginning of the world. I'm not so sure that's going to happen. I think people will realise more tax is coming. I think people who have suffered financially will try to save more. So for me, I think the equity markets will potentially actually suffer when we come out of COVID, which is very strange, because they did well in COVID. I think they'll do bad when we come out of COVID.
Well, I mean, it's the state of the high street already has changed, and you can see that. I mean, I live in Richmond, southwest London. You know, it's quite an affluent area, but House of Fraser, massive company, has already gone under. The huge building is just sitting there empty, and that's been there for as long as I can remember. And it's empty. They haven't got anyone else wanting to go in there. They're going to probably turn it into apartments, because actually retail is changing.
I mean, and also people aren't moving house. I don't know if you notice it in your area, but more people are doing building work.
Renovation.
They're staying in their house, renovation, which is good for builders and the building industry from that perspective. But if you're an estate agent, you're struggling. So there's going to be lots of sectors that do well and lots of sectors that do badly. And that's also something that you need to look at as well, is what sectors have maybe over benefited too much. They've gone too crazy. Has Amazon gone too high as a stock because it's reaped all the rewards? And then you've got cinema companies that have been obliterated because no one has been to or will go to a cinema, but people will start going back in time. So what I mean by that is, if you look at something called an RSI, a relative strength index, and our clients can do that. You can actually put that on a chart on our platform, and what that tells you is when a stock or a sector has been overbought or oversold. If the RSI is over 70, what that normally tells you is that particular stock or sector has been overbought. Therefore, there's an opportunity to short it or sell it. On the opposite to that, if a sector or stock has been underbought, let's take a cinema company, because they've been decimated, and their RSI is under 30, that means their stock price is very low. Is there an opportunity in the next 2 years when cinemas get back going again, that actually they might start doing better, and therefore their stock price will go up again? So that's something that clients should look at, and it's not just specific to stocks. You can look at all markets, and charting and forecasting is very important, and we've got some very good tools on the platform that you can look at. And also, it probably would be worth, I would suggest to clients, maybe paying to go on a charting course as well, which there's many out there that they can look at.
All right, interesting. So you can kind of learn to understand exactly what it means. Yeah. Yes, it is. It's about being aware, and I think being like I said, proactive. A lot of investment is for the long term, and if you can sit it out for the long term, there probably will be things that go down will go up again, because as you said, things that go up come down, but it's the same way.
Absolutely.
But it's depending, how long.
You've brought up a very important point as well. It's dependent on your time horizon. So if you're a long-term investor, so if you bought Marks and Spencer's shares 2 years ago, but you've got a 10-year view, and you don't care what happens within that 10 years, because in 10 years' time, that you want that as money to take out. It could be for a pension, or it could be go on holiday or anything. Then that's not such an issue. If you're a short to medium term investor, and you've bought down here and we're up here, you might want to think about selling and taking profit.
Yeah, taking profit.
And here's the other thing to mention is you don't always have to sell everything. So as an example, my brother-in-law, who knows absolutely zero about the financial markets, bought Bitcoin 5 years ago.
Wow.
He's made a fortune, and he asked me a couple of weeks ago, what do I think? And I said, you made a lot of money. Why don't you just maybe close out 3/4 of your position, take the cash, you still got a quarter of it in there. You've got money. You can take the wife out for a meal or go on holiday when you're allowed to one day, and you've still got some money in Bitcoin. So there's lots of things you can do to offset risk, and you can still keep your hand in the game and have some fun with the markets as well. You don't always have to be 100% loaded in.
Yeah, definitely. You can start gradually, can't you? You can start gradually, and as your risk appetite increases, you build it up
gradually, slowly. Never ever think you've won.
Yeah.
Because the market will come back and bite you.
Yeah.
And for me, the biggest thing is discipline.
Yeah.
So if it's 7 o'clock at night and you decide to buy the S&P, and an hour later it's up 1% and you've made a few £100, and all of a sudden you think you're the greatest trader in the world, and then you decide to go and watch television and forget, and all of a sudden it turns and it's down 3%, that's a huge lack of discipline. That's why you need to set alerts.
Yeah, set alerts and just be alert.
Stops.
Yeah.
Stops as well. You can set alerts, you can have stops. They're really important, really, really important if you're regardless of how experienced you are, but definitely if you're new to this, it's absolutely critical to have stops and alerts.
And I think you guys, you've got some great account managers. I know at EXANTE that your account manager sticks with you throughout, constantly there for you. So I guess if anyone's got any questions or queries, speak to your account manager. And
we've got a load of people with, I think, 150 or 200 years experience.
Wow.
We've all multi-asset, so they've all come from different areas. So there's a lot of experience. There's a lot of help that we can give, and we're only at the end of a phone call or an email if you need to talk. Excellent.
No, that's great. Well, thank you so much, Jason. Obviously, like you say, we don't know what's going to happen, so we've got to be alert. Thanks for the tips with the platform that we can set alerts. We can go on courses. So I think what investors could be doing now, I guess, is thinking about the future, thinking about post June 21st, what they can do to protect their portfolio. But thank you so much for joining me this morning. I'm really
no problem at all.
Lovely,
no problem at all.
Lovely to see you. This Jason Keogh. Jason Keogh. Keogh, head of UK sales at EXANTE. And thank you so much. I really appreciate you joining us on Surfing the Curves.
No problem, Simona. Have a good day.
You too. Take care. Bye-bye.
Take care. Bye.
Bye-bye.
Jason used a really interesting analogy. When someone has a heart attack, you can keep resuscitating them, but does that actually solve the problem long term? When it comes to the global economy, we can keep pumping more and more money in, but is that simply plastering over the cracks? And does it actually solve the problem long term? Who knows? As he said, equity markets have to come down at some point, but nobody knows when. As an investor, all you can do is protect your portfolio in the long run, set alerts, and be proactive. Thank you for watching, and see you again next time.